Hello everyone. Now let's talk about contingent liabilities. And as the name implies, it's a liability that's not 100% guaranteed. So some liabilities may arise from past transactions only if certain events occur in the future. We call these contingent liabilities. The accounting for contingent liabilities depend on two factors. The first element or first factor is the probability or the likelihood of occurring. The other one is the measurement, or how much is the value or the amount. The likelihood of occurring is classified as probable, reasonably possible, or remote. Probable is the word that implies a very high chance of happening. Reasonably possible, it's possible, but it's not as probable. Remote is like it's far from happening, or the chance of happening is low. The ability to measure the potential liability is classified as either estimable, where we can estimate it, or it's not estimable. In other words, we cannot estimate the amount or the value. So for probable and estimable, let's try to classify or clarify this a little bit further. So if a contingent liability is probable and the amount of the liability can be reasonably estimated, it's recorded and it's disclosed. So by recorded, we mean we record the liability in the balance sheet and we disclose it in the footnote. The liability is recorded by debiting an expense and crediting a liability. So let's see an example. Assume that during June, a company sold a product for $60,000 and that includes a 36-month warranty for repairs. The average cost of repairs over the warranty period is estimated at 5% of the sales price. The entry to record the estimated product warranty expense for June would be as follows. But before we see the journal entry, so think about warranty. It's one of those things that companies sometimes offer when they sell their products, and there's no guarantee that the customer or the client is going to use it. Sometimes nothing goes wrong, and sometimes more than expected items or products would be needing repair. So that's why it's contingent. That's why we call it a contingent liability. It depends on whether something is going to go wrong with the product or service that we provided. So if we look at the journal entry here on June 30th, we debited product warranty expense, which is an expense that we estimate as 5% of the $60,000, and then we credit product warranty payable. Why it's payable? Because we haven't used it yet. It's just we are expecting to pay it if anything goes wrong. And the expense now is going to be recorded in the income statement. The product warranty payable is recorded on the balance sheet, and it's like a liability. We're going to take advantage of it if something goes wrong. So if the product is repaired under warranty, the repair costs are recorded by debiting product warranty payable and crediting cash supplies, wages payable, or other appropriate accounts. So assume that a $200 part is replaced under warranty on August 16th. So in this case, the journal entry would be we're debiting the product warranty payable, which if I take you back to the previous journal entry, remember we credited when we recorded the warranty liability. So now we're debiting it, we're reducing this liability, and since we use some supplies, we're going to credit supplies for the $200. So in this case, we just assume that the repair needed only supplies, so we credited supplies and we debited the product warranty payable. What if the situation involves a probable amount, but it's not estimable? We cannot estimate the value. So a contingent liability may be probable, but it cannot be estimated. In this case, the contingent liability is going to be only disclosed in the notes to the financial statements. We cannot record it in the balance sheet. We cannot record a contingent liability in the balance sheet. So for example, a company may have accidentally polluted a local river by dumping waste products. At the end of the period, the cost of the cleanup and any fines may not be able to be estimated. We cannot estimate it. But most probably we're going to get fined, but we cannot know if we're going to end up paying $5,000 or $100,000. We cannot estimate the value. So we just include a footnote in the disclosures of the financial statements explaining that we have this kind of contingent liability. How about reasonably possible? Contingent liability may be only reasonably possible. In some cases, We cannot really think it's probable. It's not like 90% or above, it's below that. Um, and in this case, we don't worry too much about the amount. So if it's reasonably possible, we're going to disclose it and that's it. So for example, a company may have lost a lawsuit for infringing on another company's patent rights. However, the verdict is under appeal and the company's lawyer feel that the verdict will be reversed or significantly reduced. In this case, the contingent liability is only disclosed in the notes to the financial statements. Again, we cannot create or record a contingent liability in this situation. How about if the situation is remote? Then we totally ignore it. So if it's far from happening, we don't need to worry about it. We don't even bring it up in the footnotes or anything like that. For example, a ski resort may be sued for injuries incurred by skiers. In most cases, the courts have found that a skier accepts the risk of injury when participating in the activity. Therefore, unless the ski resort is grossly negligent, the resort will not incur a liability for ski injuries. So in this situation, no disclosures needed to be made in the notes to the financial statements because it's remote. So the next chart here actually is a good way of thinking about contingencies, and let me start with the same sequence we presented. So if it's probable and it's estimable, right? Let's see, here's the likelihood of occurring or the chance or probability of happening, and the measurement, which is being able to calculate the amount. If it's probable and we can estimate the value or the measurement, then in this case we record it and we disclose it in the financial statements. By recording it, it's recorded in the balance sheet, and the expense is going to be recorded in the income statement, and also in the footnotes we're going to have this kind of disclosure. So the only situation that would require recording if it's probable and estimable. What if it's probable and it's not estimable? Then we only disclose it. What if it's estimable but it's not probable? Then again, we're going to look at these two other elements. But the only time we're going to record it if it's probable and it's estimable. What if it's reasonably possible? Let's say it's 50-50 chance. Then in this case, we only disclose it. We don't care about the measurement. Whether we can measure it or not, it's going to be disclosed anyway. How about if it's remote? If it's remote, then again, we do nothing. Okay, so there's nothing that we should worry about here. Now, let's talk about how we present or report the liabilities on the balance sheet. So accounts payable, accruals, notes payable, the current portion of installment notes payable, and any other debt that are due within 1 year are reported as current liabilities on the balance sheet. So please remember that. These are balance sheet items and they will only appear under the current liabilities. Any remaining installment notes payable or other debts are reported as long-term liabilities. Under the condition, there are obligations to be fulfilled in a period longer than a year. And this is how it should look like. So you can see here we have the balance sheet for Starbucks, and we have the current liabilities. They have accounts payable, accrued liabilities, accrued payroll and benefits, income tax payable, stored value, card liabilities, and that would be the total current liabilities. And then we have long-term debt and other long-term liabilities to get the total liabilities. So our focus in this chapter is the top part here, to get the 6168. That's how we calculate it. So, or how we present it. And keep in mind that all these numbers are, of course, in millions. So now let's do a couple of analyses. One of them we've done before, which is the working capital, and actually the other one we also did before, which is the current ratio. So current position analysis helps creditors evaluate the company's ability to pay its current liabilities. This analysis is based on the following three measures. We have working capital, which we've seen before, current ratio. The new ratio is the quick ratio. So working capital, if you can remember from chapter 4, it's simply current assets minus current liabilities. And to calculate this measure, we have to only rely on the balance sheet. Very similar to that is the current ratio, but instead of subtracting, we divide them. So current assets divided by current liabilities. So while these two measures can be used to weigh a company's ability to pay its current liabilities, they don't show the company's ability to pay these liabilities within a short period of time. So a stronger measure would be the quick ratio. And a quick ratio overcomes this limitation by measuring the instant debt-paying ability of a company, and it's computed as follows. It's the quick assets divided by current liabilities. So what are the quick assets? We never heard about that term before. So the current liabilities are the current liabilities that we've been talking about. But quick assets, that's a new term. So quick assets, these are cash and other current assets that can be easily converted to cash, such as temporary investments and accounts receivable. That's it. So remember, cash, temporary investments, and accounts receivable are the quick assets. And we call them quick because they are assets that can be easily converted to cash. So the current and quick ratios are particularly useful in making comparisons across companies. So let's see here an example for Chipotle and Starbucks. So you can see here we have the total current assets, we have their current liabilities. The working capital is 364 million versus a negative of 504 million for Starbucks. They have more current liabilities than their current assets, which is a little bit dangerous. And because of that, you can see that their current ratio is actually less than 1. So for a current ratio for Chipotle, it's close to 2, it's 1.81, and for Starbucks, it's 0.92. For the quick ratio, we include the quick assets, which are the cash equivalents, temporary investments, and accounts receivable. We ignore the other current assets. And here you can see that the quick ratio is a little bit tighter compared to the current ratio. It's 1.64, and also for Starbucks, it's also tighter, which is 0.59. So by just looking at these numbers, you can tell that Chipotle is in a better position compared to Starbucks. So I hope this chapter was useful, and let me know if you have any questions, and I'll see you in chapter 11.